Hey, welcome! Today we're going to document a specific market DNA cycle for the S&P 500. We're going to walk through the entire setup, step by step, based purely on the model's documentation. So let's just dive right in.
So, before we really get going, it's super important to understand what we're looking at here. Market DNA is a proprietary geometric system. This means it doesn't use any of the traditional stuff. No technical analysis, no fundamental analysis. What we're doing in this explainer is simply describing the visible events and the data that's been provided. We're not going to try to analyze or guess the model's internal logic at all.
So, here's the game plan for today. We'll kick things off by identifying the news cycle, then we'll jump into the Phase 1 entry points, and after that, we'll cover the risk management framework. From there, we'll look at the projected targets and, of course, wrap up with some really crucial disclaimers.
All right, let's get into it with Section 1, a news cycle. We are documenting a fresh setup for the S&P 500 index.
This slide here just lays out the basic vitals for this cycle. The asset, as you can see, is the S&P 500 index. The cycle ID is SP500_3_1, and the date for this documentation is February 5th, 2026. Right now, the cycle is officially in Phase 1.
Okay, moving right along to our second section. Here we're focusing on Phase 1, which is all about identifying the entry points. This is really the initial setup where specific levels for the cycle are defined. And here we go. This is the chart showing the geometric structure for this particular cycle. The documentation points out that the price has already reached that initial entry area, which you'll notice is marked on the chart with the letter M.
So Phase 1 actually defines two potential entry levels. You've got the primary entry, which is labeled M, at 6,831.25. Then there's a secondary entry, PC, at 6,761.14. Now, this second level is completely optional. It's more of a risk management tool, and it may or may not ever be reached.
Next up, we've got to talk about the risk framework. This part is all about how a position size gets calculated, and it's all based on a hypothetical strategic plan.
Okay, this slide lays out all the foundational numbers for that calculation. We're starting with a hypothetical capital of $100,000. The maximum allowed drawdown for this plan is set at 5%. Then we have something called the third triangle domain percentage, which is 2.86%. And finally, a risk coefficient of 1 with a contract size of 10 units.
Now, the source material gives us a mandatory statement that explains exactly how these parameters are used, and I'm going to read it for you word for word. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. And right here, you can see how those inputs start to shape the actual position size. The mean entry price, which is just the average of M and PC, comes out to $6,796.19. The expected low price, based on the model, is $6,601.82. And all of that leads to a calculated total position size of 2.57.
And that brings us to the final output of this whole risk framework. That total position is split evenly between the two potential entries. What that means is we get a size of 1.28 for each of the two possible trades.
All right, now let's shift gears and look at the projected targets. This section is all about the model's predefined price targets, and it outlines two different scenarios that could play out. So the model gives us three very distinct targets. We have target 1, or T1, which corresponds to the mirror line, and that's set at $6,847. Target 2, T2, is at apex N, sitting at $6,928. And finally, target 3, T3, which is the trapezoid top, is at $7,015.
Okay, let's explore the first scenario. This is the outcome we'd see if only the primary entry at M gets executed. In this case, that second entry at P is never triggered.
So in this scenario, the entry is at M and the exit is way up at target 3. The expected profit calculates out to $2,352. That translates to an expected return of 2.35%. And based on the cycle's 18-day duration, the expected annual return would be 47.65%. But what about the second possibility? Well, scenario 2 covers a situation where both of those entry levels get triggered. So a position is open at M, and then another one is open at PC. In this scenario, here's how the projections look. That first trade from M to T3 still yields the same $2,352.
But the second trade, from PC to T2, adds another $2,136 in profit. This brings the expected total profit to $4,488. That's an expected total return of 4.48% and an expected annual return of 90.84%.
Okay, we are now at our final section, and I really need you to pay close attention here. The following disclaimers are a mandatory part of this documentation, and they are very important.
All right, first and most importantly, this is not financial advice. This analysis is being presented only as part of public model documentation. The use of leverage above 10 is prohibited. You should never, ever invest essential personal funds, and any risk management must strictly follow the user's own instructions.
So as we finish documenting phase 1, we're kind of left with this natural question, right? The very first target, T1, is that mirror line. So what happens when the price actually reaches that specific point in the structure? Well, that would mark the start of the next phase in the cycle.
Thank you so much for joining us for this explainer. If you want more information, you can always visit the official website. That's www.marketdnaedge.com.